folks, my name is Eric Wilkinson and I'm with Pro Trader Strategies. We're an educational company and we're here to teach you guys a few things about options. As a matter of fact, we're here to get you folks to a place where options just make sense. So if you want to learn more about options or trading around the markets, please smash that subscribe button. Also, if you have any questions, comments, or anything else throughout this video, over there in the questions, comments box, that's where I will be watching for your questions. I want to make sure you're clear of concept before we move on. And if you watch this on tape delay, I will circle back around to make sure I answer everybody's questions before going forward. And finally, smash that like button. It really does help us out. So please do that before you take off. All right, in this video, we're going to be talking about swing trades. And I'm going to touch on those, on how to spot swing trades quickly and easily. But further, we're going to talk about option strategies that we can implement around those assumptions we come up with. We don't just look at buying a call for a bullish assumption. What we do is we look at the pricing. That is what's going to determine whether or not we buy or sell options. And I'm going to show you how to find that relatively quickly. And finally, my name is Eric Wilkinson. I think I may have already mentioned that. Let's get on with the overall market so that I can get you guys to a folks where you guys understand options intuitively, and I think I can do that for you quickly. All right, so this particular one is we're still talking about bearish moves here on these swing trades, and we are going to specifically talk about swing trades, how to spot those, and then build on that with option strategies, okay? So I'm going to try and start with simple concepts and then go to real-life examples for you folks before moving on. All right, so swing trades. First, let's talk about what is a swing trade. A swing trade really is something that just lasts longer than 2 days, all right? A day trade is basically you put on a trade today and you took it off today. That is your day trade. A trade that lasts longer than that is a swing trade. If you tried to set it up on a move there. One thing, though, that we are going to talk about here is, let me get back here to this, is when we are trying to identify or look for a swing trade. What we do is we see markets that are in a bullish kind of trend, or sometimes they're just stuck in the mud and trending sideways. And then we also see those bearish trends, right? Well, ultimately, when we are looking at those trends, we see the market kind of jostlate back and forth, right? And same thing for a neutral. We see those swings happen, and sometimes they're not always going to hit the same spots, but what we try to do then is find the resistance area where that underlying loses momentum and support, where it finds a base there, where buyers come in, resistance, support, right? And then the thing that we are going to set our trade up on is not necessarily an overall bullish trend or any of that. What we are doing is we're looking for when this hits those support or resistance areas and start reverting back, okay? So this ultimately is what we're looking for, is a bump up against that resistance, and then for that pattern is where we are going to set this up. So we have a bullish trend, a bull trend with a bear pattern inside of that trend. So we would look to take advantage of this on a sell-off, all right? And a bullish pattern within a sideways trend, a bullish pattern within a bear trend, okay? You see what we're getting at there? We specifically are trying to look at the overall broader picture and then start narrowing it down to find that pattern within the overall trend, because that's where we are going to set up our trade. So, for instance, with this, we can see that this is pretty much a neutral trend. And then if I go in and see what the overall market is doing, I can see it doing things like this, right? And that is ultimately what we're looking for. We can find some resistance areas up here, some support areas down here, and that's ultimately what we want to take advantage of, is when we bump up against a resistance or fall to a support, and then we start getting some candles that really start shaping up to show us that momentum shifting. Some people like to look at line charts. I like to look at the candles. It just gives me a better picture in my mind of what's going on. And usually in swing trades, I'm looking for candles that look like these type of candles. I don't want to set them up right next to each other, or that's a tombstone. So those are the type of patterns. They could be green also. I'm not necessarily saying that they have to be red on these types of moves. They could easily just be the green counterpart to those, and they would look very similar on a chart setup where you have a hangman doji, a spinning top doji. All right, so those are the things that we're looking for at the top of a move, and we just happen to get one right there. And that would be something that I would look for in setting up a swing trade for losing momentum and seeing this underlying start to sell back off, maybe to the point of control or something. So I can see I've got an overall neutral trend. I found the support and resistance. You can blur your eyes and kind of see where this underlying has lost its momentum to the upside and gained support where the buyers started coming in and supporting those levels. That shows you really where people start to think, okay, this is a little expensive or it's kind of cheap. And that's really what we're trying to do with options trading as well, right? We're trying to find those places where the momentum starts shifting, all right? And that would be something we would look for in an underlying like this. So ultimately, when we're swing trading, we want to identify that trend, right? Is it bullish, market neutral, or bearish? And then we want to look for the overall support and resistances in that underlying, right? Then where we're going to base our trade is on identifying that pattern. That's going to be the key to, only the camera's showing. Oh my gosh, you guys. Thank you very much for blowing that up, Dan Arnold and Zeke. I have a tendency, because the way we used to do these, I would have that already taken care of for me. So I have a tendency to get on these and start popping. And I forgot about that. So let's go back to this again. I'm going to kind of start over again real quickly. But ultimately, what we're trying to do is look for the overall trend, spot the resistance and support areas, okay? So we're looking for the pattern within the overall trend. This is what we're looking for to spot our swing trades, right? So we can see that we can see the resistance, support areas, and then the overall pattern within the trend, right? So bearish trend with a bullish pattern within that. Here we have a bullish pattern, bullish trend with a bearish pattern inside of that bullish trend, okay? Now you're all good now. Guys, I'm so sorry about that. We're trying to work this out, and I get ahead of myself and forget to click on that one little button after I get started. I've been doing that in the daily market commentaries. I even have this. All right, so that's what we're trying to do there. And here again, back to this IBM, we are looking for, let me just erase this and I'll start all over. Erase all that ink. Go back to the pen. So in this IBM, we are looking at an overall neutral trend, right? I'm trying to change my pen color while we're talking here. And so we can see that we've got an overall neutral trend. And then we look and kind of blur our eyes and try and find this, what this underlying is doing by that, right? And then I blur my eyes a little bit and look for the resistance. And then I can kind of see where this is a support area. Yes, it will break down sometimes below and above those support and resistances. Just know that it is probably going to be losing some momentum there. Yes, you are going to look to get out, pull the ripcord on that trade if it breaks below your support area, if you've gotten into it. But look for it to resume, and once it comes back inside of that area, that's where you want to take advantage of a bullish move. So in this, if you had gotten out of the trade, maybe got involved here, you got out, just re-enter as soon as it comes back into those areas of support and or resistance, okay? And then after we do all of that, we want to identify the trend, whether it's bullish, market neutral, or bearish. find or identify those support and resistances where you see that thing starting to lose some momentum to the upside or gain support where the buyers come in on the downside. And you will be able to see this show up a lot in the markets once you start getting used to it. Yes, we will see markets where we were getting that move right there. That's where we were talking about before. Actually, I think it was slightly lower right there. And the next day, we never got a confirmation. It blew off to the upside. So that would have been your out above the setup bar if you got in a little bit early. I would say, generally speaking, folks, if you're looking for a move, like a bottom here, say the market came down and you're looking for this as a bottoming pattern, listen, it gives you a signal, but until it's confirmed, it's not real. You're being very aggressive, okay? And I am an aggressive trader where I will have a tendency to get involved on this candle here, all right? If you have a little less risk tolerant, wait for it to confirm, meaning it settles. You get a green candle the next day if you're looking for a bullish move, that it finishes above that, all right? Vice versa, if you're looking for it on the upside, and you got a candle like this at the top of a move, right? You got a big move to the upside, you got this candle, that's something you're going to be looking for on a market, a momentum shift, or the pattern to start rolling over here. But an aggressive trader would get involved sometimes on this candle here, okay? If you are less aggressive or have a lower risk tolerance, I should say, then wait a little bit longer. Wait the next day for this underlying to get confirmed to the downside, or that is a topping pattern. So the next day you would want to see a candle like this where it closes below the previous day's low, all right? And you would be out of this trade above that wick, okay? So if this market starts reverting, all right, I'm getting a little ahead of myself on talking about the outs here, but, you know, the next day, if it started getting a green candle like this, started blasting off and settled way at the top above basically that wick there, then that would be something that would get you out of this trade, all right? And that's exactly what happened here, all right, with this swing trade. It will have a tendency to pop up and above. The one thing I want to talk about here is why would we want to use, because you will see this happen to you. You know, it's not going to happen every single time, folks. It will break through every once in a while because probabilities are that it will, all right? There's going to be about a 25% probability with this trade that it's going to break through our short strike or have our directional move incorrectly, all right? We picked the incorrect directional move. Only 25% of the time will it bite us. If you were to short this underlying, that would have been dollar for dollar, you would have felt that pain. In the trade that we're talking about today, we would have had a lot of wiggle room. I would have been able to get well above this second level of resistance because we could see that this was a resistance we were kind of looking at. Actually, this was the area of target, but this is the resistance area we were looking at. And then there was another resistance area slightly above it. We kind of saw it test in the past. Well, that held the first time. So this option strategy would have allowed you to stay in this a little bit longer, okay? Whereas if you were short the underlying, you would have been in a world of hurt almost immediately. So this one, it's going to take advantage of a downside move, but you are not going to get hurt nearly as badly as if you had picked the underlying outright, okay, or shorted it. There's also all kinds of headaches that I'm not even necessarily talking about. If you short an underlying, you have to pay margin, you have to borrow the underlying. Sometimes they're hard to borrow, all of those things, maintenance. There's a lot of cost goes into shorting, which is why most people don't short a stock. Well, we're showing you in these webinars how you can implement options to take advantage of those short opportunities, all right, and not have the risk you would with borrowing a stock or shorting a stock outright. And again, like we talked about, the market continued to pop up. But with options, we would have been out, or with options, we would have been able to stay in this trade a little bit longer, I would have been out on the earnings. But what I'm trying to say here on this move that we got involved, it popped up into this area here, but because the short calls were above that resistance area on the Fibonacci's, it never really got tested. So I was able to stay in this a little bit longer. I ended up getting out of this trade for a scratch, but at the end of the day, I picked it on that trade, tried to get involved on a bearish move candle setup. Market didn't work out in my favor. But what I want you to take away from this is you don't always pick the directionality right. But when you're using options, you can increase your probabilities of success. I was directionally wrong here, but I didn't lose money, all right? It was basically a scratch. I think I ended up making a little bit on it, but it was basically a scratch for all intents and purposes. And I take that as a win any day of the week. But with options, it gives you a little bit more wiggle room to be right, and you have higher probabilities of success that way. Now, we've been looking at this SPY chart since I don't even know how many months back, folks, and it's been following this trend. We even talked about it in the daily market commentary, the setup on it coming down and testing this trend channel, basically, that's lasted since 2018, and a bullish move off of that. So these are the types of candlestick setups we're looking for here. Came down, tested a support level, right? Got the confirmation, even a 50-day simple moving average. We're talking about that in these daily market commentaries a little bit more, where that is something that shows longer term bullishness as soon as you pop above that. And that would be an opportunity to take advantage of SPY off that trade. And if you were watching the daily market commentaries, I did take advantage of that. We still have that trade on. But here's a trade I want to look at for today's market. Now, the rest of the day, we started getting a little bit of a high, it kind of rallied into the close. But I think that the energy sector is a little bit overdone at this point. Yes, there is some demand for crude and those things, but I do think that the energy sector has run quite a bit and is due for a little bit of a pullback. So I'm looking to add some negative deltas to my portfolio, which just means that I want to take advantage of some bearish moves here in this underlying. So when we're looking at options, we need to talk about options really quick. What are options? Well, a call option gives the buyer the right but not the obligation to actually buy the stock. So if XYZ, if we're given a simple example, XYZ is trading $100, all right? And I buy a call at the 105 strike, all right? I buy the 105 calls. Doesn't matter what I paid for it. That gives me the right, but not the obligation, to buy the stock at 105. So if XYZ during the life of my option trades 120, right? Those 105 calls, meaning I have the right to buy the stock at 105, are immensely valuable, right? Of course I want to buy it at 105. It's trading 120. But what if I bought those 105 calls and it went down or stayed right here at 100? Do I want to buy XYZ at 105 when it's trading 100? No. You just say, hey, I don't want it, right? So the call buyer has the right but not the obligation. You're paying for that right. You bought an option, so you paid out for that. You're paying for that right. And if you are the seller of the option or the call option, then the seller of the option has the obligation to deliver the stock. Now, if you don't own the stock, you got to borrow it. You basically got to go out there and you're short that stock in your portfolio. All right. We're going to offset these as soon as something like that happens, as soon as your short strike gets breached. But with the seller, the call seller, they have to deliver that stock at that price. So if our example back here, I bought XYZ stock or call option at 105 and you sold it to me, and it's trading 120 right now, and you sold me those 105 calls, I can call you out and say, hey, you got to give me your stock at 105. So you would have to sell it to me at 105. Okay? You got to keep that premium, though, that I originally paid to you for the contract, though. All right? And the put buyer has the right, but not the obligation, to sell that stock. All right? So out of this example, if I had bought a put at the 95 strike, that means I can sell XYZ stock at 95. Currently it's trading 100. Do I want to sell XYZ stock at my put strike price of 95? No. Right? I can go out there in the open market and sell it at 100. Save myself the money. But if the underlying fell to say 75 and I can sell my stock at 95, what am I going to do? I'm going to offset it. I'm going to take my right to sell my stock to whoever sold that put to me. All right. And obviously then the put buyer, or the put seller, put seller has the obligation to take delivery. Means he has to buy that stock from me. He has to take it into his account. All right. You just dump it off to him. All right. So an easy way to remember this is you call up and you put down. All right. So that's, if you're really new to options, that's the easiest way to remember it from the call or from the buyer's perspective is if I call up and I put down. All right, that's how we used to teach newer traders and stuff like that on the floor how to remember. Call up, I put down. All right, so if I'm a buyer, I want it to go up if I buy a call, and I want it to go down if I buy a put. All right. All right. Now, one thing with options is every strike that we talk about, like that 95 call or the 95 put or the 105 call, those have a premium associated to that. All right. The seller gets that premium and the buyer has to pay or buy that. All right. So all options aren't necessarily created equally because we have to look at the pricing to determine if they are expensive, the strikes are expensive or cheap. So what we do is we flip over to the option montage. All right. This is the page I'm always going to call the option montage if you ever have any questions. And we're looking at XLE. And for this underlying, what we want to do is volatility is something that really determines our options pricing. All right. People are going to say time does, all of those things. Yes, that's true. The further out in time, those things are more expensive, right? But at any given time, these prices can go up and down. And the only thing that can really, aside from the underlying moving, if the underlying, what I'm saying is if this underlying doesn't move a penny, all right, these prices could still be fluctuating. And the reason why they would be fluctuating is because of this thing called Vega, all right? And it's just a fancy name for implied volatility, all right? So if you ever see me write implied vol, that means implied volatility. I'm not going to ever really talk about volume so much. So these numbers for Vega actually tell us if these premiums are expensive or cheap, okay? Now, not 30. When I'm looking at this number 30, or right around that number 30, that's not saying it's expensive or cheap. We have to see what this number 30 means in relation to this underlying. Because Tesla will probably never get an implied volatility as low as 30, okay? That would be unheard of for Tesla. I don't know if it's ever had a volatility coefficient of 30, implied volatility. So what we need to do is look at this number and figure out where it has been in the last basically 6 months, highs and lows. So on a chart, I pull this up at the bottom. So when we're looking down here for implied volatility. That's that Vega coefficient, folks. And it got pushed off to the side. So what we need to do is to determine where this point is right now versus this low and this high. Okay? And we can pretty much see without really doing any math that it is pretty low, right? We can see that the volatility is closer to that lower end of the range. And know that with implied volatility, folks, it is like what we see with charting, right? Where I talked about the support and resistances. You will see like support and resistances and supports, and the chart for implied volatility. And I'll give you a better chart than that. Let's zoom in on that chart. How about that? So what we want to do again is find this mark where 31 is in relation to this high, which is, I'm going to call 59, and this low right here, which I'm going to call 28. All right, so we've got the high and the low. We need, what we're trying to determine is where this is in relation to that range. You know, what I like to say is this is the sell zone, and this is the buy zone. All right, so you want to be buying premium down here and selling premium when it is elevated at those levels. And if you really want to dig into the details of this, you basically take the current implied volatility minus the low implied volatility. You take that sum and divide it by the sum of the high implied volatility minus the low implied volatility. All right. So really what this is telling us is where we fall in this range. So I would take 31 minus 28 and take that sum and divide it by 59 by 28. And we come up with 3 divided by 31. So that's going to be like 9. I'm just going to say it's like 9.6 or something, 9.6. So basically it's in the 9th percentile. I mean, it's in the lower 10% of this entire range, which leads us to believe that volatility is pretty cheap, okay? So do we want to buy options or sell options? Well, when they're cheap, it is, Zeke, give me a second. Well, we could see that they were pretty cheap, right? But what if I expected volatility to continue to come out, right? If we talked about volatility comes out, our premiums go down. Well, volatility, if I'm worried about volatility continuing to come out, do I want to buy that option? Maybe not. Is there a way that I can kind of offset all of this stuff and not have to worry about that volatility or theta? Yes. And that's what we're going to be looking at with this strategy, because when we are looking at the bearish risk reversal, you know, we are seeing cheap premiums, all right? But we're going to do this for a credit. And the reason why we want to do this for a credit with this strategy is it puts our break even much higher, all right? So if you do this for a debit, your break even is going to be much lower than where you currently are. If you do it for a credit, that break even is going to be much higher than where you currently are. So doing this credit on the risk reversal is imperative, folks. It doesn't make any sense over my 25 years of trading this to find a situation where it was more beneficial to do this for a debit. One might say that, hey, you're going to have to put up less money by about $50 or $75 per one lot. That's not worth it, folks. All right, because your break even is going to be several dollars below where you are currently. All right. Now, normally what we talk about is this thief in the night that comes and steals our premium, right? So if we want to do something when we're buying it, we want to limit that theta decay, right? And if we're going to try and limit that theta decay, we need to go out in time, right? Now, I'm going to basically negate this thief in the night with this strategy, all right? But having said that, I still want to give myself a lot of time to be right. I can set this strategy up inside this wheelhouse, 35 days to expiration, or I can set it up out here. It's going to cost me the same. I'm going to have to put up the same amount of money. So why not go out in time and give yourself more time to be right? All right. Inside of here, you only have about 35 days to be right. What if this underlying just starts trending sideways for a little while before it rolls over? Well, or breaks above your resistance area where it would get you out. This strategy will be able to stand that test of time better than going out and buying, say, a put when it was cheap for a bearish move, okay? Because if volatility came out and you bought that bearish put, it would hurt. And if the underlying just traded sideways, you bought a put, the thief in the night is going to be stalking you, all right? We're going to try and create this as a situation where we don't have to worry about any of those things. All right, Zeke, sorry, I forgot about you for a second. Vega is a great name for volatility. If anyone has ever ridden on the old Chevy Vega, they're more volatile if you've owned one. That's true. And Vega, something about Vega, it is the only name on the option montage that's not a Greek. Delta is a Greek. Theta is a Greek. Rho is a Greek. So is, what's the other one? Gamma. Vega was made up. It's the only non-Greek. All right. So that thief in the night. We can see, generally speaking, that theta right here, if we're looking at SPY, and this isn't old, we're trading much higher than this, but it still gives a great representation of how theta is not linear, meaning it's not going to take $1, and it's consistently only taking $1. What it does is it starts out, it takes $1, and then it takes $1.50, and then it takes $2, and then it takes $2.50, similar, just to give you an example. It starts ramping up the closer we get to the final day, all right? It continuously ramps up. You can see that, with 23 days to expiration, this underlying sees 12 cents a day coming out of these premiums. Further out in time, you can see basically going from 58 days to 23 days. So we're talking about 35 days. This has gone from 8 cents to 12 cents. Well, let's look at this. This 30 days, it's only increased by about a penny from here to here, right? So if you want to limit theta decay, you want to get outside of that 70 days to expiration. And if you want to take advantage of theta, then you want to get inside that 35 days to expiration. But again, with this strategy, I'm going to show you how we can negate some of these factors with theta. That thief in the night. So with this one, this is the one we're going to be considering because I'm looking at XLE for this trade. Again, I just want to show you the theta. You can see between, here to here, we've increased at least a penny from here to here. It didn't really increase that much, right? It did, and this is probably a rounding error to make it look like it didn't increase that much. It did increase a little bit, but you can tell it did not increase enough compared to that closer to expiration. And again, you're going to be putting up the same amount of money if you put up the strategy in this option montage in any of those expiration cycles, okay? So, having said that, give yourself more time to be right with this trade. So, again, we're looking at XLE. Now, I would try to look at this as trying to draw some support and resistance lines in there, really dirty, I guess. But what I'm looking at is this candle right there. That's one of those candles that I'm looking for at a top of a move. It's not the very top of a move, and it didn't quite get to this area of resistance before it started rolling over. But I want to take advantage of it based on this candle setup and everything else looking pretty good with this trade. So, what do you guys like to look at for a reversal? Is there any kind of candlestick setup that you guys are really interested in looking at to determine a type of move? I'll tell you one that I really like is this one right here. It comes up and bumps up against the the 50-day simple moving average. I've got that nice spinning top candle right there, pretty much. A confirmation tomorrow would be really good. Only thing I'm a little worried about is the earnings over here for that one. But, candlestick setups like this is something I really like to look for in those types of moves. Sorry, trying to change pages, and that's in my way. All right, so the bearish risk reversal, folks. There's a couple of things with this bearish risk reversal. Something that people use this for, not only for a bearish move, all right? This really comes involved when you're really bearish, right? Then you're probably going to go towards something like a synthetic short, which we've talked about. But this one, you're a little bit more worried about the underlying kind of, you've got this worry that it's going to trend sideways before starting to roll over, right? And in this time, that theta decay would really hurt you in many other strategies, all right? And if you thought it was going to go sideways like this, I wouldn't pick a synthetic short either. That's just going to be stressful for you watching it bounce back and forth. So with this one, basically you would be able to set this strategy up where you're getting short calls and long puts and taking this. None of this stuff hurts you in there. All right. So one thing we talk about, delta tells us the rate of change to an option premium. Now, I usually kind of breeze over this part a little bit, but I'm going to talk about this because when we're talking about deltas, all right, delta tells us that our options premiums are going to change based on the underlying, okay? So we're talking about a dollar move, and the assumption is the dollar move is always higher, okay? So when we're talking about options, and you're looking at those option montage, those numbers, just know everything is assuming we're moving higher. All right. Delta means it goes $1 higher. All right. Our premiums are going to be affected that way if it goes $1 higher. Volatility goes 1 percentage point higher. Okay. Theta goes 1 day by. All right. All of those are correlated to a positive move. So if I bought a strike that was 25 deltas, that means when the underlying moved higher by $1, my premiums increased by 25 cents. All right. So it's correlated that way. And why is this important? Because we're going to try to build this strategy out to be as close to 50 deltas as possible. Okay? That's the key to this. We were trying to get it around 50 deltas. And the reason why people use this in a portfolio for a hedge, because literally what it does is it hedges basically half of your portfolio. All right? And I'm going to show you how to do that math here in a little bit. But what you're trying to do, if you were long XYZ 100 times and I wanted to hedge 50% of that in case it started selling off or take advantage of a sell-off there, maybe I don't want to take capital gains on my underlying, all right? And that's why I don't want to sell the stock and I'm putting an option strategy around it, right? To take advantage of like a rollover, you'd put in something like this risk reversal, and when the underlying rolls over, you take advantage of that correction with this strategy, and then you take the strategy off and you still have that underlying in your portfolio, and you don't have the capital gains issue that if you took it off for that momentum shift, all right, and then bought it back in a couple of days later or whatever. All right, so we want to try and build this for about 50 deltas. Another thing I talk about is this is data. So delta tells us data, all kinds of data, but most importantly, the probabilities of being in the money. All right. So a 25 delta, like I was referring to, has a 25% chance of being 1 penny in the money at expiration. All right. Again, that's 1 penny in the money at expiration. All right. The probability of my strike getting touched or getting punched, or the market comes up and hits my strike, that is 2 times the delta. 2 times the delta equals your probability of touch. All right, 2 times delta is your probability of touch. And why do I tell you this? So that you guys can keep your powder dry, so you can stay mechanical. That's what trading is all about, not getting emotional. And that's how I try to teach is if you know all of the levers and pulleys and what's going on, you look at the back side of a watch and all of those levers and pulleys are going, well, if you're a watchmaker, it makes all the sense in the world, right? That's what I'm trying to make you guys. I'm trying to get that option montage to not be so scary. You start looking at it and start zeroing in on those areas that I'll be talking about, and all of a sudden it's not a flight simulator anymore. All right, so the risk reversal, bearish risk reversal. We want to buy a long out of the money put, and this is about a 25 delta put, all right? And this is going to be about a 25 delta call is what we're looking for. It's not always going to be exactly 25, folks. So we're going to try and get it as close to government work as we can. So when we're looking over here at the option montage, I told you, I want to give myself enough time to be right, so I'm going to go a little bit further out in time, and I'm going to pick about 85 days to expiration. Now, I'm going to be looking for the options that are around 25 delta. Something that note with options, right? Note the deltas on the calls and the puts. The calls are all positive. Calls are positive. The puts, the delta is negative, right? Because remember, I told you delta, or the options Greeks, are all assuming 1. So $1 higher, underlying moves $1 higher, my premiums in the puts decrease, right? It's getting further away. It's not going to be as likely. So as the underlying rallies, those puts get less valuable. But if the underlying goes down by $1, so a negative $1 plus a negative delta makes that delta positive to my position, right? So if the underlying starts going down, then my premiums on the put side starts increasing, all right? And remember, a 25 delta, underlying goes 25 delta put, negative 25 delta put, underlying goes down by $1, my negative 25 delta put increases in premium by 25 cents on that dollar move, right? Now, if I set this up as a strategy, right, you can see I picked a 26 delta and a 28 delta. I couldn't find the 25s, right? Calls are positive. Now, if I am making this a directionally bearish strategy, all right, first thing I do is I go to that one that is the closest to a 25 delta put, all right? That's the one I want to buy. So I go in there and I buy the 50 put. It's going to tell me I have to pay about $1.34 for it, okay? So I have to pay $1.34. I told you I want to do this strategy for a credit no matter what. That means I have to sell a call for at least $1.34 or more to get a credit. So I'm picking the 60 calls, all right? So now let's put this all together. I told you that the deltas are assuming a positive move, which is this call. It's a positive 28 delta, right? All right, so let's put this together. And we've got a put here that's a 50 strike, and it is a 26 delta, all right? So I buy the 50 put. So if I buy the 50 put, I'm basically negative 26 deltas, right? And if I sell this call, if I sell a call, or here, I sell the 60 call, let's just do it this way. I sell the 60 call, right? If I sell a call, that makes I sell a positive delta, that makes those negative 28 deltas, right? So I add all this together, what do I come up with? I come up with 55 deltas, negative, right? I add those up. I do that math right? Yeah. Oh, 54. Sorry. Anybody catch me over there before I changed it? 54. So for every time that if this goes to 53.80, right? That means it went down by $1. Then my trade on this would increase by 54 cents. All right? Does that make sense to everybody? I don't see anybody throwing anything over on the questions, I don't think. All right? So I have essentially hedged 50%, right? If I was long 100 of the underlying, because when the underlying goes down by $1, my position in my portfolio on that underlying would lose $1, but I would gain 54 cents on this, all right? So what the idea here is if you have a long-term bullish portfolio, which most people do, where it's filled with underlyings or outrights, you could do this around something. Say, for instance, you were tech heavy. You could do this with the triple Qs and hedge that portfolio, all right? And I'll show you how to do that towards the end here. But one of the things I want to show you here is this we did in the 85 days to expiration, right? We were looking at this in the September, doing it for a slight credit. Now, if I do this on the Analyze tab, we can see that my break even is right here. That's where those 60 calls are that I'm short. I'm short those calls at the 60. That means right now we're trading right here. I have a lot of wiggle room to the upside. I have like $5 of wiggle room to the upside to be wrong, right? If you were short this underlying dollar for dollar, you would be feeling it. But if the underlying rallies goes higher than where we currently are, then I don't lose money until it gets above 60 because I've done it for a credit. Now, you can see that your buying power is going to decrease by $700 for every one contract for XLE. Now, if I go further out in time and pick the ones that are 176 days to expiration, still the same credit. Notice, though, that I did have to get a little bit further away to make that 50 deltas, all right? To get that as close to 50 deltas as I could, all right? Otherwise, it was going to be, if I did the 50, 60, I was going to have on closer to 70 deltas or something like that, which I didn't necessarily want to do for this trade. So just know if you go further out in time, the more and more time you're buying yourself, you're kind of making your spread a little bit wider, which means you need a further bearish move in order to profit from it. Now, again, your break evens, because I did it for a credit, is going to be up here at those calls where my short calls are. So I am not going to lose money unless this thing gets up and above 63. All right. And I start making some good money below 47. Now, if you do this for a debit, right, I can set this up for a debit pretty easily. I went into the 85 days to expiration, went a little bit further away. Say, for instance, I was worried about my short calls, and I said, you know what, I'm going to go $1 further out to that 61 call. Well, now I end up doing this for a debit. Remember, before my break even was up above 60. But if I do this as a debit, it shifts my break even to the flip side. So yeah, I've limited my risk to the upside by $1, but that's cost me basically, what, $5 to the downside, right? What would you rather do? Probably do this for a credit because your break even would be here, $10 away from where it is now. So that doesn't make a difference, right? If you do it for a debit on this one, my break even is $10 different. Does that make sense to everybody? Why we want to make sure out of everything we do, when you are doing a risk reversal, do it for a credit. There's nothing you guys take away from this webinar than doing a bearish risk reversal for a credit, then I've done my job, I think. All right, so I'm trying to set it up based on this candlestick set up here. I'm looking for it to roll over and at least test the 50-day simple moving average or come back down to this little area in and around this point of control is what I'm looking for this trade. So a couple of dollars move to the downside. So we talked about this. When you're doing it for a credit, your break even is the call strike price plus the credit. That's your break even. When you are doing this for a debit, it's the put price minus the debit. Completely opposite ends of the spectrum if you have. Now your max loss is infinite because the underlying, you're short a call. So you're going to lose money as soon as it goes above that short call. All right. Break even, your max profit is the underlying goes to zero. None of us are going to wait for either one of those things to happen. On and out, I'm getting out above yesterday's high. All right, so that's $55. I haven't put this trade on yet. I don't like to do the whole fake pump and dump stuff. So I actually put this trade. I do have this trade on now that I think about it, but I got in on it on this setup. So I have on a different strategy that I talked about in the daily market commentaries last week. But I got in on this on that setup. Yeah, I got a bounce there. It happened quickly. If I was short the underlying, right, I would have been really happy one day and terrified the next. Well, with this one, my short strike on this strategy, I think, is up around 65 for this trade. I can't remember right offhand exactly what my strike location is, but I got involved a little bit earlier on this. But get out above the setup candles high or the setup candles low, being, you know, you got a candle where you don't have your pin going, you know, the setup candle being, you know, something like this at the bottom of a move, right? This is your out, right? On a move. If it were on a bullish move, if I could switch it over to my green. Oh. So yeah. There, and you know, that's your confirmation. So let's say you got in on it and then the next day it started rolling over. You're still looking at basically your out being right there on that setup right there. That's your out. If the underlying starts selling off, you're still looking out. Some people would maybe switch it up. Okay, next day I'm moving my out to here. Next day you can stair step it on a bullish move like that, right? Bearish move, same thing. I've got a red candle there, you know, above that wick. A trade above that wick is where I'm going to be looking to get out on that, right? Trade above that 55.55, all right? All right, so one last thing I want to talk about real quick before I let you guys take off. But one thing to do when you're trying to figure out how much you need a hedge on a portfolio, okay? So what you do is you take your portfolio, whatever your portfolio value is, okay? All right, so your total portfolio value, and you divide it by the sum of the strike price, or your strike, whatever that strike number is, the strike, just the strike, and then times 100, all right? So let's just say, for example, you have $100,000 in your account. Let's just say let's say you have $500,000 in your account, right? 100,000 of it is allocated to tech, okay? And so I want to hedge it with something like the Qs, which I don't know what the price of the Qs was exactly today, but let's just, or where it finished exactly. So let's just call it 350, okay? So I'm looking at hedging my $100,000 tech portfolio with the Qs, and I said it was, what did I say, 350? I think 350 times 100, okay? It was 350, right? I'm getting SPY 425 stuck in my head. I just want to make sure. 350. All right. So $100,000 over 35,000. So you take 100,000 divided by 35,000, and basically that ends up being right around 3.5, right? 3.5 contracts is what we're talking about. So 3 contracts. I would go a little less, folks, than a little bit more. You know, but if you're really bearish and you're really worried about that, then maybe roll it up to doing 4 contracts, because you can't do a half one. All right? So 3 contracts is what I would look to do to hedge a $100,000 portfolio. And basically you're trying to get that correction, take that part of your this trade off for that profit, and you've hedged the downside by about 50%. Make sense so far? So this is how you would do it in a portfolio. If you're doing it as an underlying, you know, for instance, you own the underlying and you wanted to protect it, you would do it the same way. What the value of that stock is versus the strike times the 100, okay? So if you're trying to do a whole portfolio or a specific stock, this is what you're going to be looking at to do that. Make sense to everybody? Anybody else have any other questions before we get going? Before I move on? All right. Well then, without further ado, here you guys go. This is what we're going to be offering you guys. I think we've already thrown it over there in the window there. I'm going to throw it over there. It is I think I showed it over there. Right there's the link for you. So this is it. Instant access over to 15 hours of content. We're going to be showing you how to spot trades using that market profile. That's that little blue side over there on all my charts. I use that all day long because it shows support, resistances, where you're going to lose momentum, where value of that underlying is. I talk about all that stuff in here, when, where, and why we use options, and how we can find those trades, all kinds of stuff. So please check this out. Like I said, the link is over there on the side for you. Any questions, comments, or anything else later on, I will circle back around. But for 36 bucks, you guys, if you made a bad, if you guys set up a risk reversal as a debit, I just saved you guys 36 bucks by doing that. All right. If you've ever done it, I've saved you money and a lot more than $36. So you guys can take advantage of that. Finally, if you have any, it'll take you to this link right here. This gives you a little bit more detail on everything. You can see that there is tons of information there for you guys, all kinds of content that you can just take advantage of at your leisure. As a matter of fact, if you watch this one, it basically puts a check mark by it and you've known you've already watched it. All right. So if you have any questions, comments, or anything else, future webinars you'd like to see, you can reach out to us 310-598-6677 or email me at trading@protraderstrategies.com. All right. That's all I got for you folks. Again, like I said at the beginning, hit that subscribe button so that you guys get access to the videos when we're doing these. I do daily market commentaries where I talk about the economic data, see what the markets are doing, and then talk about my trades. And then these webinars where we drill down on those on these option components and show you how you can set these strategies up so that you can increase your probabilities of success. Just like this one. As simple as not doing it as a debit. Do it as a credit, right? And I guess that's about it, other than smash that or take that. Bye for now, and take it easy. Take care, everyone.